I typically, for this strategy, I use the 1 hour chart. So I focus my efforts on the 1 hour chart. I don't, in the midst of these trades, ever really look at any other time frame chart. You certainly could, but I don't. So now let's talk about stacking, and we'll talk about stacking in the context of the regulations as well. We're going to talk about a buffer zone. A buffer zone is an area in front of my profit target so that I'm not actually, if I think that, I'll get out of the camera for a moment, Warwick, sorry. If this is your profit target down here on a trade, and you have a statistical reason to believe that that's your profit target, whether it's a moving average or a moon cycle or something, whatever you've got, and that's your profit target, I typically place a buffer zone in front of that profit target. So the currency pair doesn't have to go all the way to the profit target, but it can go close to that profit target, but not all the way. It doesn't necessarily need to go all the way there. It just helps me get out of trades. I don't want to be in the market very long. I don't want to stay in the market longer than necessary. And so I typically have a 10 to 20 pip buffer zone in front of my profit target, whatever it is, that allows me to get out of the trade before it even hits the profit target. Stacks are the way that I trade. This is a stack. A stack is 5 to 10 trades spaced an equal distance apart, placed on the way to the profit target. So when the point was brought up, well, what do I do? What's pyramiding or stacking or whatever? As the trade goes in my favor, I add to the trade. So I add to my risk. I cost increase instead of cost average or cost decrease. I actually add to my winning positions. I've spoken about this incessantly for the past 3 years. So for some of you, it may just seem like the most boring discussion on earth. But why would I do something as crazy as increase my risk as the position goes in my favor? Why would I do that? Because it's going in my favor, right? I mean, that's what you do with relationships, right? It's going in your favor, so you keep it going. I mean, life, this is the way it works. You taste rotten food, and you don't hungrily add to your losing position, right? You don't say, wow, this is a losing position on rotten food. I'm going to pile up on it because the more I eat, the easier it will be for me to throw it back up. I don't know what what we're all thinking, but I don't cost average or reduce my cost basis. If something's going against me, then typically I'll jump out of it. I don't want to be a part of it anymore. If something's going in my favor towards my statistically viable profit target, then I'm going to continue trading in that direction. And so I'll sell stop towards my buffer zone profit target, and then what I'll do is I'll stack additional trades on the way down to that profit target as it goes in my favor. So that if it goes against me after opening the first position, I'm only in the smallest part of my position to start with. As opposed to, for instance, taking 2 positions to start with, which is your maximum amount of available trades to take, and then taking the maximum stop loss on those positions if it goes against you. So when I take a loss, I would like to take a loss with the least amount of exposure, but when I take a gain, I want to have the most amount of exposure. It doesn't guarantee you any profits. With reward comes risk, because if it turns around on me once it's down in that zone where it's opened up all those trades, that could be damaging. But remember, once it's down in that zone with all those trades open, you have the choice to close those at a point in time that might be suitable for you. Does anybody have any questions about stacking, pancakes, risk? I'm going to answer the question next about using leverage in association with this. I typically do not trade a trade size too large for me to stack all the trades that I need to that I'm going to show you with a 50 to 1 leverage. I don't need more than that. So I typically don't require more than that. However, if you trade a very small account and you're accustomed to stacking a lot of positions and using all the leverage available to you in your account, then this trade size typically needs to be reduced. I'm going to tell you something that's not listed on the slide, but I'll tell you what my trade size typically is. I typically trade between a half of a mini lot and a mini lot per $20,000 in the account. So Andy, having worked at a broker, having seen the trade sizes that people throw around with a $20,000 account, that would typically, I think, be a smaller than ordinary trade size. Okay, for this type of trading, I'm trading like 1 mini lot per $20,000 in the account. So it's $1 a pip in either direction, you know, for every $20,000 in the account. So that's a fairly small trade size for each trade in the stack. Now on the $800,000 account, you know, I'll typically trade 3 to 4 to 5 to 6 standard lots per position in the stack. A week and a half ago, when I took a really good trade that we'll talk about, I think I had 75 standard lots open all at once. And so that was a fairly large position. All the positions were open in the stack, and I was wearing an extra pair of adult underpants and freaking out big time. Yeah, per trade in the stack. So for every $20,000 in the account, about 1 mini lot per trade in the stack. For every $10,000, about a half a mini lot for every trade in the stack. For every $5,000, about 2 to 3 micro lots for every trade in the stack. And for every $1,000, I'll just trade a standard lot. Just go nuts. It's just $1,000, right? No, I'm just totally kidding. Totally kidding. 5 to 10 trades spaced in equal distance apart in the stack. And we'll talk about this in a moment. I'm going to get to what it looks like in the context of an actual strategy.